Hello, welcome back to the channel and welcome back to the final video in the Adobe deep dive that we've been doing. We have looked at the business model, we've looked at the financial statements, we've looked at the moat and how they compete in the marketplace, we've looked at the threats and the opportunities related to AI and some of the competitors like Canva, and we've even looked at the management team and tried to understand what the business might want from its next CEO. Today, we're going to take all that scattered information and we're going to put it together into a bull case, a bear case, and a base case somewhere in between. And honestly, we're just going to do it at a high level. We're not going to get super technical and specific with it, but one of the things that I've learned in my career as a CPA and senior financial analyst is that it's not always necessary to be perfectly accurate. In fact, a lot of times when you try to do that, you end up making everything a lot more complicated, and you're sort of tricking yourself into a feeling of accuracy that is false. And it's usually better to actually put your effort into being directionally correct and close enough, and giving yourself a margin of safety when it comes to actually making a decision. So before we get started, a couple notes on how we're going to do this. At the time of filming, Q1 FY26 data has been released, so we're going to use last 12-month data, or LTM, in order to have as much up-to-date information as possible. So that means we're going to be starting from Q2 FY25 up until the end of Q1 FY26. So it spans two different fiscal years, but it's still one whole operating period. It's just using the most recent information. Secondly, this is not financial advice. This is just academic and a chance for us to practice our skills as analysts and try to use some business acumen. So keep that in mind while you're watching. The price of the company might be different now, as well as the entire underlying landscape. And one other thing, I should let you know that I do own a little bit of Adobe stock that I bought before performing this analysis because I like to own the company before doing research. So just full transparency there. Without further ado, let's jump into it. Okay, so what I've done is I've just asked Claude to build me an Excel file, which allows me to put in a few different assumptions for different cases. So we'll have our bull case revenue growth, our base case revenue growth, and our bear case growth down here, as well as the free cash flow margin assumptions down here. And then I've gone ahead and I've pulled all the last 12 months data that you need for a discounted cash flow analysis. You can pause it here and take a look if you want, but it is just pure inputs based off the financial data. And then one more thing before we move on is that one of the most important assumptions you're making when you do a discounted cash flow is the WACC, or in other words, the weighted average cost of capital. And this is the rate at which we discount back cash flows from the future. And it sort of represents two things. The first is the underlying principle that money today is worth more than money tomorrow. And that is because we don't know what the future will be like, and we might be dead in the future. So it's just better to have the money today than to expect to have it tomorrow. The other side of it is that money has an opportunity cost. So when you invest in a company, you are taking on risk because you might not get that money back. And for doing that, you expect to hopefully get a higher return. But the alternative would be maybe to put that money into government bonds, which are very safe and you're almost certain to get that money back. So there's an opportunity cost there. And the rate that you use for your WACC in your discounted cash flow analysis has a really big effect on what the outcome is, and therefore the price that you're valuing that stock at. For the most part, you're almost always going to see a WACC of somewhere between 8 and 12% for most established businesses that you're going to look at. In terms of the terminal rate here, the terminal rate is what rate is the company going to be growing at once it and its industry is fully mature and it's just sort of ticking along generating cash. You're typically going to set it somewhere between 0 and 3%, which is either essentially negative growth against the economy as a whole or around the same rate as GDP growth or the general economy. It's just going to grow at the same rate as the economy and keep going forever. So I'm going to use 2.5% for this. And then the AI bull case for me really comes down to 3 points. The first is that AI expands the scope of creative work. It is a behavioral changing technology that allows us to be more creative. Professionals are creating more art, individuals are creating more things, and businesses are creating more assets for their advertising campaigns. This would be AI expanding the TAM, total addressable market. The second point is that Adobe captures most of this market. They're able to use their position as the current leader in the creative marketplace to become the go-to tool in the AI landscape. And then third, I'm going to assume that increased costs in the short term are a given because of the expensive nature of AI inference costs. However, I'm going to assume that those costs are temporary. And that's because the AI data center build out is going to happen. Moore's law is going to bring down the cost of inference compute. And then there's also going to be algorithmic improvements that mean that not as much compute is needed in the first place. So how is that going to affect revenue? We know that Adobe has a few different customer segments. The first is the business and consumers group, which is Acrobat and Express. So what Adobe's doing right now is that they're providing these as cheap and accessible AI tools, and they're essentially subsidizing it and using it to convert those users into the Creative Cloud ecosystem. It's a bit of a loss leader, with AI compute costs being the cost of customer acquisition, but our bull case will assume that there's a lot of freemium conversion as people buy AI credits on Adobe Express, and they use those to create their images and use some of the more advanced paid features of Adobe Express. The constraint to keep in mind here, which is going to exist in the bull case and the bear case, is that there is already a lot of good options for this kind of technology with Copilot and ChatGPT and Canva are all really capable alternatives at the low end. Going back to the financial statements, the business professionals and consumers segment over the last 2 years went from a 19% growth rate down to a 15% growth rate. So we're seeing some deceleration in the current numbers that we're already sure of. The bull case, therefore, we will say, because of these constraints, is that it stabilizes at 13%. So we'll see a little bit more of a drop on that 15%, and then it will stay where it is at 13% growth year over year. The second group we'll look at is the creative and marketing professionals, of which one part of that is the Creative Cloud. So like we already talked about, the bull case here is that AI is expanding the scope of creative work. Now, in that scenario, AI must be really, really good. So the value of the creative professional isn't going to come from the tools that they use, but rather it's going to come from their originality, their taste, and their ability to refine a creative vision into a real piece that people want to consume. Our bull case here is that Adobe wins as that tool because it's already the standard, it has the most capable tools, and the fleshed out ecosystem. Don't forget, we went and we looked at schools from all over the world, and they're still teaching Adobe tools in their classroom. So this is pretty reasonable. There's no reason to believe Adobe is losing ground as the industry standard creative tool. In fact, this Italian school from Milan even has their students writing to the school basically saying that we need more Adobe focus. It's not enough to just have open source tools or other tools. Those need to be supplementary to Adobe products. And then because professionals are still needed, but there's so much more content being created, we actually need more professionals rather than less. We're going to be able to use AI to generate something like this, which was created by ChatGPT. However, there's going to be things that aren't perfect. This corner is going to be needed to be touched up so that it's perfectly aligned. They're going to be needed to make edits to things like this so that this also has an icon. And while this is a pretty incredible page, it probably is quite busy and kind of maybe a little bit too much. So maybe you're going to want someone who's going to be able to come in and take this part out or this part out and just sort of take this as inspiration, make the edits that are needed, and then send it off to the printing team or whoever else is in the workflow. And then finally on Creative Cloud, we're going to assume that the seat-based pricing issue gets figured out. Again, if Adobe is providing more value to the customer, they're going to be able to find a way to negotiate for better fees and to continue to be compensated for it. Now, looking at the FY25 financial statements, digital media revenue, which is mostly Creative Cloud, grew 11%. So I think in this bull case, we're assuming that a lot goes right, and I think it's fair to say that we'll expect this growth rate to accelerate in the future as their tools integrate AI capabilities, and we'll assume that this expands to 14%, above current levels, but still nothing crazy. And then finally, as we've been discussing, I think Digital Experience Cloud is the most interesting opportunity for Adobe in the AI world. If AI generates 10 times the content volume, enterprises need AI content supply chain management to allow them to personalize all of their content and their assets to different individuals in different markets, collect and analyze the data, and then manage campaigns across their various campaign platforms like Google and Meta, etc. And Adobe is already here, and it's already a huge focus for them. That's the agent orchestration layer, where we have these agents basically underpinning all their apps, including the ones that marketing professionals and enterprises use to manage their campaigns already. Adobe's already here. They're just integrating everything on top of an agentic AI platform. So beyond just having the capability in their software to do this, we're also going to assume that the new CEO, whoever it ends up being, has the enterprise credibility and relationships to make this happen, to align the organization in a way that they're able to grow this offering at the scale that they need to. And like I said, I think this service has the highest upside. So considering that it just grew 9% in FY25, I'm going to assume that that also accelerates up to 13%, so a 4% growth. And we use those growth rates, will come out to roughly 13 to 14% blended growth rate for the bull case scenario. So what I've put into the model is starting with the 12% growth rate, very close to what we saw in FY25, and then accelerating up until FY30, and then we start to see a downtrend as we approach the terminal value out into the rest of the decade. If we do want to monitor this going forward, I would say the two important metrics to look at is the ARR growth rate. Like we saw, the growth rate has typically been between 12 and 14% and rising, but we did see in Q1 that amount dropped to 11%. So if we saw that continue to decelerate, especially at the pace that it's going right now, and it drops to 7 or 8% in Q2, that would be a very worrying sign. And I would say that the bull case is very unlikely to be playing out if that's true. The other thing I'd want to keep an eye on is the remaining performance obligations. So again, historically, these have typically been ticking up, and they've typically been coming down, although it has slowed down a little bit in terms of the percent that is going to be recognized in the next 12 months. And what this really is signaling is whether or not customers are committing to Adobe for long periods of time, whether or not they feel comfortable that they will need Adobe in several years. That's what this shows you, and that's why I think it's really important to monitor to understand whether or not the bull case is taking place. Okay, now on the cash flows, it's hard to escape the fact that the bull case relies on an AI-first strategy, and that basically guarantees higher costs because inference compute is a lot more expensive than regular compute. But again, for the bull case, we're going to assume that Moore's law and algorithmic improvements bring down the cost quickly. Not immediately, but quickly. And we'll also assume that some costs can be passed on to the customer through price increases or through credit packs that the customer is able to buy. And starting from a 41% free cash flow rate as of FY25, what we'll do is we'll assume that it drops quite a bit in the short term, but then as data centers are built out and the science improves, those margins will recover. Not quite back to where they were, because I do think that inference will probably always be more expensive than regular compute, but more or less where we were before. To be honest with you, I think that this is slightly aggressive. I just think that costs are going to go up and they're going to stay high. However, this is the bull case, and we'll work those scenarios into the base case and the bear case instead. Metrics that we'd want to monitor here to understand if the bull case is happening is first and foremost Adobe's hosting services and data center costs. In Q1 of FY26, this cost went up 14% versus the prior year's Q1, which is really significant. And if that continued, I would be worried, as well as Adobe's R&D expense to see if that continues to go up, as they may need to spend more in order to increase their AI capabilities and stay competitive in the marketplace. And then finally, the other alternative measure that I want to monitor is the cost of image generation from some of Adobe's competitors. So, ChatGPT Image 2, watching this price per token to make sure it's coming down and at what pace it's coming down, as well as Gemini Nano Banana and whatever else comes out next. So that's the bull case. Let's now go look at the bear case, because I think it's easier to look at the best case scenario and the worst case scenario and then come up with something in the middle for the base case rather than going straight there. So my bear case is again underpinned by the idea that AI expands the scope of creative work. I do frankly just believe that AI is a technology that is going to allow people to do more and to make more content. Whether you think that's good or bad, I think that's going to happen. However, in the bear case, Adobe is not able to capture that growth. The growth happens, but Adobe is already too far behind, or they're not able to get out far enough ahead in order to capture that expanded market. And what we see is not a collapse of Adobe, because it is still the industry standard and people are kind of stuck on it, but rather a slow erosion of its customer base and therefore its revenue. So let's take a look at the same groups of revenue that we looked at before: the business, professional, and consumer. So the bear case here is that this funnel of Acrobat and Express trying to push users into their more profitable apps just does not work. They don't need to open their PDFs in Acrobat because they can just upload it into their favorite AI tool and ask questions. And for Express, Adobe simply fails to get product market fit with it. I don't know about you, but I've tried using Express and I've tried using Canva as part of this research, and I just found Express to be a less enjoyable experience than some of its competitors. It didn't work in one of my browsers. It was kind of finicky. I felt like they were always trying to upsell me at every single step along the way. And I struggle to see a world where Adobe wins with that strategy when I can just open ChatGPT or Google Gemini and ask it to create an image. Again, I feel more confident in this because I am a low-end customer. I'm not a professional creative, and I'm not an enterprise officer looking for advanced workflows for my employees. I'm okay with good enough, and I don't feel like Express is the best option for me for what I'm looking for. And so here, because we're in the bear case, we would be expecting deceleration, and that is frankly already in the data. Remember that we dropped from 19% growth to 15% growth in FY25. So we're going to assume that this just continues and gets worse. Now, on Creative Cloud, there's definitely a bear case to be had where AI just completely wipes out the need for Adobe. Tools like Claude Design get so good that you can just ask it to make something like this, and then you can just use these as tweaking sliders to get it exactly how you want, and you just simply never need to open Illustrator or Photoshop or whatever. That is a fair bear case to have, and if you think that's your bear case, you should put it in your own model. But for me, to think about it a little bit more level-headed, I would say, I think that we're still going to need creative professionals for originality and truly differentiated design. And we talked a little bit about why I think that in the last video, so if you haven't seen that, you can go and watch that. However, Adobe's fundamental value proposition is that professional creative work requires professional-grade tools. So the bear case for me is not that AI replaces creative workers, but rather it just reduces their reliance on the tools to execute their creative vision. They still need the apps for the final touch-ups and to get everything perfect, but they don't need it for the original image or animation generation. So if that's the case, even though they still need Adobe, that's a reduced value proposition. And if that happens, I think Adobe would struggle to retain the pricing power that they currently have. If their value proposition is reduced or diminished, it will simply, in my opinion, reduce their ability to raise fees on their current customers. They can do it, but they'll see higher churn rates because of it. And that's why I'm forecasting a slow erosion. I think they're going to try to increase their costs, but what they're going to see is that they're going to have professionals slowly churning out rather than leaving en masse, which leads to a stagnation of their revenue or a slow decreasing of their revenue over time. So if we have a current growth rate of 11% in FY25, I'm going to forecast a deceleration to sort of mid-single digits and then low single digits way out into the decade. And then thinking about Experience Cloud, if the last situation occurs, it means that AI got really, really good. And that does lend itself to the agentic enterprise opportunity, I think. We're basically saying that AI is good enough to kill Acrobat, Express, and Creative Cloud, but that also means that this agent orchestration business model for enterprises is probably able to function pretty effectively as well. So maybe in the bear case, Adobe just has to make a big pivot to this as their business model. The problem is that in this space, they're not the first to market, they're not the industry standard already, and they're competing against some pretty heavyweight alternatives like Microsoft and Salesforce. And then finally, are they able to do this without their key man, their CEO, who's been the CEO for like 18 years? Is the new CEO, whether it's internal or external, going to have the authority and the reputational capital within the business to make the big decision to pivot the whole company from Creative Cloud to agent orchestration? I don't know. That seems kind of unlikely to me, I think. That would be really impressive if they were able to pull that off. And then finally, don't forget that this agent orchestration business model has a value proposition that stems from it being integrated with Creative Cloud that creative professionals are going to use. If Creative Cloud loses relevance, then Adobe's digital experience layer also becomes less valuable. So honestly, I find their digital experience side of the business really tough to forecast. On one hand, I think AI is this massive opportunity. And on the other hand, I think it'll be really hard for Adobe to execute and make the most of that opportunity. So what I think I'm going to do for Adobe as a whole in terms of the revenue is assume that growth stays relatively resilient over the next couple of years, but then really starts to slow down in year 3 and then ultimately continue down into kind of the end of the business, out into the end of the decade. This is kind of a scenario where Adobe loses and kind of becomes a shadow of itself and one of those companies that we look back on and remember for not being ahead of the curve and ending up being eaten by a new technological wave. The cash flow bear case is going to be a similar story with a few compounding issues. Basically, we're going to assume that a lot of the data center build out gets canceled. I'm reading articles that nearly half of all US data centers are being canceled or delayed, so that seems very possible. And if that's the case, it means compute costs aren't going to come down as quickly as needed. Their gross margin percentage is going to shrink, and ultimately Adobe doesn't have very much control over this. It's something that is just going to happen and they can't really manage it. The second point is that Adobe has to fight to stay relevant because their revenues are eroding. So they have to either make acquisitions, or for this scenario, we're going to assume that they have to increase those R&D costs that we looked at previously. And instead of something like this, we might see it start to tick up quite a bit more as we go into the decade. And because of their losing pricing power, they're not able to push those costs onto the customer without losing more of their subscriber base. This is a pretty bad scenario for Adobe. So here's what we're going to say. Over the next 5 or so years, Adobe is going to have a pretty steep decline in their free cash flow margin because of those increased costs and the inability to pass those costs on. But then out into the end of the decade, it's going to just stabilize at a lower rate as those compute costs sort of stabilize and we settle into what the new industry looks like. Okay, so we've looked at the bull case and we've looked at the bear case, and our base case has to be somewhere in between, but probably not exactly in the middle. And again, this is just me really speculating on what I think might happen, but my feeling based off being a user of their apps is that their business and consumer revenue continues to decelerate basically at the pace that it is now. I don't think it's a total collapse, but I definitely think it will slow down. But that's mostly on the Express side, and I think Acrobat itself will probably hold relatively well because it's already embedded in enterprise workflows, and I don't think consumers make up a huge portion of the revenue from that app specifically. On the creative and marketing professional side, I think that the Experience Cloud will continue to grow. I've said it a couple times now, but I think there's a lot of opportunity there for Adobe. But I am going to forecast a slower rate than I typically would because I think the CEO transition for me is really worrying. I just don't like the idea of losing a CEO that's been there for almost 20 years and has done a pretty good job, has led the company through its last major transition. And the fact that we just don't even know who the new CEO is yet is really hard for me to wrap my head around. So I'm going to say that the CEO transition creates some issues and it basically slows them down over the next 12 to 18 months, which is probably the most important period for the company in terms of capitalizing on AI as an opportunity. I do think that the professional base of Creative Cloud users will hold because that's what they're learning in school. It's what they've spent their career using. And I don't think that we're going to see these mass layoffs because of AI. So I would say that it holds, but I would also stick to the bear side of it in saying that their pricing power does decrease because AI reduces the value of the product itself. So again here, I'm going to forecast a very slow diminishing of revenue over the next decade. For cash flows, I do think inference costs have a pretty significant impact in the short term, but I do think that Moore's Law and maybe even more importantly, the algorithmic efficiencies will normalize those costs out into the later years. So that might look something like this, where we start with these high margins that we currently have. It decreases over the next couple of years because of AI and because they continue to rely on AI to fuel their growth and stay competitive. But then Moore's Law and those efficiencies kick in and their margin comes back. However, never back to the same level that they currently have now. So if you want, you can pause this and take a look at it, but I'll just move on, because if you do all the math, under the bull case, we're looking at an implied share price for Adobe of over $600, a base case price of $420, and a bear case of $300. Now, when I originally made the model, the current price was around $240, and I think it's risen to maybe $250 right now. But nonetheless, that would imply a pretty significant upside to the current price. Now, the thing that I'm also thinking about here when I see this is, first of all, this is pretty compelling. But I would also say that I would want a very significant margin of safety for Adobe. The fact is that this analysis is based on a few things that I don't truly feel I understand. The first is the pace of AI. I try to keep up with it, but it moves so fast, and the people that are working in the industry have such a different opinion on where this is going than everyone else, and that really concerns me. It makes me feel like I could very well be wrong about my expectation that it's not gonna totally change everything all at once. The second major concern I have is that I am not a professional creative. I've used Adobe products, but I am ultimately a low-end customer, and I don't feel I truly understand the importance and power of the applications. I try to relate it to Excel as a finance professional and like, what would I think about AI replacing Excel? But I don't know. That's just an analogy, and I'm sure there are gaps in that analogy. I also am not a marketing professional, so I haven't used the digital experience, and I don't really understand how valuable it is for them and how valuable it is for enterprises. And then finally, I'm not a software developer. So I don't feel like I totally understand how powerful AI might be for competitors being able to add features that Adobe has in some of its professional apps for a cheaper price, right? Like Canva's purchased Affinity and has made it a free/freemium product. But what if they're able to use AI to recreate like 90% of the features that Adobe products have? I read that some developers think that AI is horrible and will never be able to make enterprise grade software, and I read the exact opposite. So because I don't have that personal experience, I think I would want at least a 30% margin of safety built into my purchase price of the business. So those are my thoughts. That's my quick and dirty valuation. If you guys do want something more complicated and for me to walk through something like this in more detail, I'm happy to do that. Or if you want me to look at another company or another industry and do another multi-video deep dive on those, I'm happy to do that as well. I really enjoyed making all these videos, and I appreciate you guys watching. So if you like it, please give it a like. I spent many hours researching Adobe and putting this together for you. I hope it was valuable, and subscribe if you want to see more. See ya.